Hello. Welcome to another episode of Money Shiksha with Brijesh Parekh. I'm your host and wealth coach Brijesh Parekh. In today's episode, we are going to discuss why a mutual fund portfolio review is essential in the current volatile market in today's unpredictable financial climate, marked by rapid economic shifts and geopolitical tensions. A mutual fund portfolio review, also known as M.F.P. stands out as an essential practice for working professionals and entrepreneurs. With market volatility affecting investments at an unprecedented rate, understanding the importance of regularly reviewing your portfolio is crucial for maintaining financial health and achieving your long-term goals. This post delves into the significance of M.F.P. Rupees, drawing from real-world experiences and expert insights to guide you in navigating these turbulent waters. Now let us understand market volatility. Market volatility is a term that refers to the fluctuations in the price of financial instruments, including mutual funds, stocks, and bonds. These fluctuations can be influenced by various factors such as economic data releases, geopolitical events, and changes in monetary policy. The recent surge in inflation and shifts in government policies have intensified these market fluctuations, leaving many investors feeling uncertain about their portfolios. For instance, during the COVID-19 pandemic, we witnessed unprecedented market swings that left many portfolios reeling. According to a report from the Reserve Bank of India (RBI), the volatility index V.I.X has surged, reflecting heightened investor anxiety about future market stability. This kind of volatility can erode the value of your investments, especially if they are heavily weighted in equities, which tend to be more susceptible to rapid price changes. Understanding the implications of market volatility is crucial for investors. It demands a proactive approach to portfolio management, where regular reviews can help assess risk exposure and realign investment strategies in response to changing market conditions. For instance, an investor who heavily invested in technology funds may find that their portfolio is overly exposed to sector-specific risks as the market shifts. A timely review could prompt a reallocation toward more stable sectors, mitigating losses during downturns. Now let us talk about how to reassess risk tolerance. One of the primary reasons to conduct a mutual fund portfolio review is to reassess your risk tolerance. As market conditions evolve, so too can your personal circumstances and willingness to take on risk. For example, consider an individual who started investing in their late 20s, filled with optimism and a high-risk appetite. As they approach significant life milestones, such as buying a home or planning for retirement, their risk tolerance may shift dramatically. Reflecting on my journey, I recall a time when I was heavily invested in mid-cap mutual funds, believing in their growth potential. However, as I transitioned into a new phase of life, my priorities changed. I found myself feeling more anxious about market downturns and began to question whether my investments still aligned with my financial goals. A thorough portfolio review revealed that I needed a more balanced approach that incorporated stable, income-generating assets alongside my growth-oriented investments. This reassessment is not just about how much risk you are willing to take, it also involves evaluating how much risk you can afford to take. Life events such as job changes, family growth, or economic downturns can significantly impact your financial situation and, consequently, your risk tolerance. Regularly reviewing your portfolio ensures that your investments reflect your current financial landscape, helping you to adapt and make informed decisions. How to realign financial goals? Your financial goals can evolve over time, influenced by life changes, career advancement, or shifts in market conditions. Conducting a mutual fund portfolio review provides a valuable opportunity to realign your investments with your current objectives. This is particularly important in a volatile market, where sticking to outdated strategies can lead to missed opportunities or increased risks. For example, consider an entrepreneur who initially designed their portfolio to fund their retirement. However, as their business grows, they may now have additional financial responsibilities such as funding their children's education. A portfolio review would highlight the need to shift focus from aggressive growth funds to more stable investments that can generate consistent returns over a shorter time frame. How to track fund performance in a volatile market? Not all mutual funds perform consistently. A thorough review allows you to evaluate fund performance against benchmarks and peer funds, enabling informed decisions about whether to hold or replace underperforming assets. For instance, if a mutual fund consistently underperforms despite favorable market conditions, it may be time to consider alternatives that align better with your investment strategy. Utilizing metrics such as the Sharpe ratio and expense ratios can provide insights into how well your funds are managing risk and delivering returns. The Sharpe ratio measures risk-adjusted returns, helping you gauge whether the returns of a fund justify the risk taken. Meanwhile, expense ratios can impact your overall returns, particularly in a volatile market where every basis point counts. During my own portfolio reviews, I have discovered funds that seemed promising but ultimately underperformed their benchmarks. By taking the time to analyze these funds, I was able to identify more robust investment options that not only matched my risk tolerance but also positioned me for growth in a changing market landscape. We need to adapt to market conditions. Different market environments favor different types of funds. In bullish phases, growth-oriented funds may thrive, while in bearish or volatile markets, value stocks or defensive funds can offer greater stability. A well-timed switch can mitigate losses and open avenues for potential growth. For instance, during the recent market fluctuations, I noticed that my portfolio was heavily concentrated in large-cap stocks, which were experiencing significant volatility. After a thorough review, I decided to diversify into sectors that were underrepresented, such as healthcare and renewable energy. This proactive approach not only mitigated risk, but also positioned my portfolio to capitalize on sectors poised for recovery. Understanding market trends and economic indicators is key to adapting your portfolio to current conditions. For example, if inflation is rising, it might be prudent to consider funds that invest in commodities or inflation-protected securities. Conversely, if economic indicators suggest a recession, allocating more towards defensive sectors such as utilities or consumer staples can provide a buffer against market downturns. Let us understand the power of diversification. Diversification is a cornerstone of risk management in investing. However, it's important to recognize the potential for overlap in your portfolio, which can undermine the benefits of diversification. For instance, holding multiple funds that invest in similar companies can lead to concentrated risk rather than spreading exposure across different sectors. During my own portfolio review, I discovered excessive overlap in my large-cap stock holdings. While I believed I was diversified, I was inadvertently concentrated in a few key companies. By consolidating and diversifying further into underrepresented sectors, I was able to reduce my risk profile while also enhancing growth potential. The principle of diversification extends beyond just asset classes. It also includes geographical diversification. Investing in international mutual funds can provide exposure to growth opportunities in emerging markets while balancing risks associated with domestic market fluctuations. Finally, taking action regularly. Conducting a mutual fund portfolio review is not just a best practice, it is an essential strategy for navigating today's volatile market. By proactively managing your investments through structured reviews, you can enhance your portfolio's resilience against market fluctuations and ensure that it remains aligned with your financial objectives. As working professionals and entrepreneurs, your time is valuable. However, dedicating time to this process can lead to more informed decisions and a stable financial future. Consulting with a financial advisor can also provide additional insights and help tailor your portfolio to meet your specific needs. In light of the current market conditions, now is the time to take charge of your financial future. Don't wait for the next downturn. Schedule your mutual fund portfolio review today to ensure your investments are working for you. By prioritizing these practices, you can navigate the complexities of today's financial markets and secure a brighter financial future. That's all for today's episode of Money Shiksha with Brijesh Parekh. I hope you found these insights helpful and inspiring. Join us next time for more valuable tips and strategies to unlock your financial potential. As always, thank you for tuning in. Be sure to subscribe to Money Shiksha with Brijesh Parekh and never miss an episode where we bring you more insights, strategies, and inspiration to help you achieve financial success.